Well, we just got the Fed meeting minutes yesterday. We got a strong ADP report this morning. We see wage inflation potentially taking off at over 7% according to ADP. We've got to talk about the Fed. The Fed is probably not feeling like they're winning this morning, but we need to have this conversation with Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you today?
I'm doing well, man. So for a long time, it kind of felt like the Fed was winning, right? CPI headlines gone from 9.1 to 7.1. PCE is down. It's all of these things. And then we get a couple of really strong jobs numbers. We got a JOLTS report that appeared good last month that was revised higher this month. So now it doesn't look so good. We got the Fed saying higher, longer, and slower. Ugh, what's going on with the Fed? What do you think they're thinking this morning? Because we got a crazy important jobs number tomorrow, which really could move the needle.
Well, I think actually the Fed is thinking, I told you so. We've been like,
You're right.
I think
You're
that's
right.
exactly what they're thinking. They're saying, we've been telling you guys for the last 3, 4, 5 months that there's not going to be a Fed pivot. We're going to keep on raising interest rates. And here's why, right? Because it's interest rates have been so low for so long. There's so much inflation baked into the economy that it's just going to take longer for us to get to the point where we've tamed inflation again. And what part of this, honestly, we talked a lot about investors or perceptions, right, in the last two segments. One, we talked about people's perceptions of inflation driving inflation. Another one, we talked about investors' perceptions of risk versus safety versus risk as driving behavior. Well, look, Wall Street has been so addicted to low interest rates, not just Wall Street, I mean, the property markets, everybody's become so addicted to low interest rates that they can't conceive of interest rates being normal again. So they basically keep on saying, well, the Fed they have to lower rates. They have to lower rates because their whole business model has depended on this, right? They don't know any other, they haven't made the psychological adjustment yet. And frankly, I think there's a lot of fear as well about what higher interest rates, are going to mean. But do you mind if I share something else with you,
Yeah, go ahead,
Michael?
please.
Yeah,
Please.
so I'm going to screen share again. This is my big day for screen sharing. So
using Zoom for all it's worth.
Yes, exactly. So hold on a second. Let's get the screen share going. All right. So I just want, Michael, this is something you look at like all the time, right? But
all the time.
I just thought like, I want to drag this out today and just sort of have a look and see where we are relative to history on interest rates. And so this down here at the lower right is this, massive interest rate spike that everybody is, freaking out about, right? Mm-hmm. But I just want you to look at this in historical context. I mean, so for where we are 410, right, at the end of December, I mean, for most of this chart, interest rates are higher than that, right? Mm-hmm. For most of history. And so, as recently as 10 years ago, they were all the way up in this level, right? And you just see them, the Fed drops them after recessions. They tend to let it run too long, and then they just lost their minds and let it run like, they dropped them to zero and just kept them there for 6 years, right? Which is just made no sense at all. And then, they tried to raise them and they did little incremental raises until Wall Street lost its mind, and they started loosening again. And then COVID hit and they just dropped it back down to zero. But if you look at this chart, I mean, historically, they've been much higher. And guess what? Do you think real estate investors were losing money like here or here? Like, you think they were losing money when real estate was like at this point? I mean, maybe they did if they went crazy in the crash. But the point is that at all these points along the line, people were making money in real estate and people were making money in stocks. And the market will just adjust accordingly. It's only when you buy at the top and you have that inflection point that you're having.
This is why when people go back and look at what I've done for now 22 years, I get in and out, right? I built my career on houses and then realized I couldn't buy my ninth house. And I'm like, shit, what am I going to do? So then I 1031 into apartments, and lo and behold, the housing crash happens. I had no idea that was coming. I just knew that I couldn't afford a house. And then, we start heading into 2019. Everybody's a syndicator, so I sold a couple of apartments, and lo and behold, the pandemic, and I left money on the table. But yeah, I'm not afraid to pivot. I change my asset type all the time. I am getting super excited about multifamily, not because of today, but because I know this is a cycle, and there's a lot of people that bought at the top. So yeah, I look at this chart a lot.
Yeah, so that's really the only point I wanted to make, is that people are freaking out, but you have to put things in historical context. The interest rates that we're talking about today are not they're not high. I mean,
Yeah.
they're just not high by historical standards. So people have made money all along. It's just math, folks, right?
It's
Now
just
the
math.
market's going to adjust, and it's going to be painful for the people who bought at the wrong time.
Yeah, there will be
with
people that get
bad
hurt.
debt.
That's what happens
Yeah.
in cycles. Yeah.
Yeah.
Yeah. So
So
so when you talk about the Fed, I've been calling a terminal rate of 5% for the better part of a year now, knowing that that's where they had to go. Neil Kashkari came out yesterday with a piece that said basically they have to go to 5.5.
mhm,
And I part of me thinks that because the Fed only has two tools, in my opinion, right? They have really three, I guess. They have the Fed funds rate, which we talk about every 6 weeks.
mhm.
They have their obviously QT, right, where they're rolling out their balance sheet. But the one that I think they're going to be flexing, and the one that I think Neil was flexing yesterday, is their voice.
Yeah.
And they're trying to create fear because they don't want like, let's just say Neil came out yesterday and said we're almost at the top. The market would go bananas.
Yeah.
Right.
Yeah.
Because, they would say, okay, no more rate increases. Let's go on Fed pivot, Fed pause. So I wonder, I don't know. I might change my opinion tomorrow on where the terminal rate is based on how strong the jobs number is. But do you have an idea on how high you think they might have to go? Because the jobs number the last couple of days have been pretty strong.
I mean, you always ask me this question, and I'm not the economist like you are, so I can't really make a prediction. But I'll just put it in a different context, which is, I think I just take the Fed at its word. It's going to keep on raising,
Yeah,
and
exactly.
and kind of leave it to them, right? I mean, they're the ones who are like doing nothing all day, but poring over this data and trying to figure
They've
out
been
what to do.
remarkably consistent.
Yeah.
Yeah.
So, and I mean, really, I mean, I think you got to give Powell credit, because he's, from the get-go, he said we're going to have to raise rates a lot, and it's going to last a long time, and that's just what's going to happen here. And Wall Street said, "Oh, we don't believe you," and all the real estate
Yeah.
people said, "Oh, they're going to
Look at
have."
the bond market. Look at the 2-year note. They're all saying you're
That's
lying.
right.
You got to pivot. Blah blah
That's
blah.
Yeah. You got to pivot, or you're going to cause a recession, and you're going to have to raise rates, means there are lower rates, and then there's all this stuff about the average time between the last rate hike and the first rate
Yeah.
loosening is 6 months or whatever it is, and so they're going to have to. And I just have to say, like, every time anybody says somebody has to, like, and that's,
Oh,
they're basing their investing on somebody else has to do this thing.
yeah. No.
I always go,
Oh,
no,
oh.
it's yeah, it's like a few years ago, I was getting into arguments with people because, like, Howard Marks had said that the debt cycle is X number of years long, and therefore we're only in year whatever how many years he said it was, 24 years, or now we're only in year 16. So therefore, because Howard Marks said 24 years, we have 8 years to go. And it was like,
yeah, I don't like those. I hate those too. It's like, really?
Yeah. It's so, like, please don't base your investing on that.
Yeah.
Please build in. So
Yeah. Do your own homework, please.
Not just that, and your own homework doesn't mean like the way you want it to be. Like,
Yeah.
you go and you
Echo
find
chamber stuff.
Right, you go find some source that says what you want it to say, and that's your homework, right? The homework means you got to really understand what's going on, and you have to plan accordingly, and you have to plan for the downside. This is what I always tell people: you can't just think about the rosy upside all the time. That's how you get hurt. The best investors in the world are the ones who really spend more time thinking about the downside than the upside. The upside,
it's about upside takes care of itself. You have to protect the downside.
The upside takes care of itself, and that's frankly why, when I first got started in this business, the mantra was, you invest for cash flow. You don't think about appreciation. Appreciation will that's the icing on the cake. It'll take care of itself. And the reason for that was because cash flow is essentially like your margin of safety. If you think about it, right? If you're producing an 8% return, on this, that means that you have 8% to decline before you're like
Yeah.
not making your debt service, right? Before you have risk. That's your margin of safety. When you're buying at a 4% rate of return, you've got half the safety of an 8% return, right?
Yeah.
So, and you're saying, like, oh, well, I'll make it up on the back end because cap rates are low. That could change. And we're
That
seeing
could change. Yeah.
exactly that. But
Yeah. It's funny when you talk about one of the things I actively seek is opinions different than mine. And one of the ones I'm seeing the last 48 hours is a lot of people, or I don't know about a lot. There are several well-known people saying that deflation, Michael Burry being one, George Gammon being another, that's crossed my radar, basically saying inflation is over and we're going to have a deflation this year and the Fed's going to cut. I don't see it. I think there's a lot of people looking at goods inflation, which is certainly rolling over, that are extrapolating that to everything else. And I think that is a fatal mistake. I can't see deflation this year. Can you?
I no, I don't see it. I really don't. I mean, I don't see how we get there without there being like a collapse in the jobs market or something like that, which I just right now, all with the jobs numbers coming in the way that they are, it's just very hard to imagine things like turning on a dime. I mean, look, all of the the crying and gnashing of teeth over like the Fed funds rate going up, how much it's gone up, hasn't slowed anything down, right? And I know there's people say, well, there's a lag time and all this sort of stuff, but this has been going on for
we're about a year
now,
into
right?
this now.
Yeah, exactly. And so the fact that they still haven't tamed wage inflation, it means that there's a way to go. Now, I do just on the wage inflation point. I mean, this is a little bit off topic, but I'm curious, Michael, what your thought is. I wonder if like some of what we're seeing in terms of wage inflation is also really reversion to the mean, like where wages were depressed for such a long time, for decades, wages were depressed. The wages were not keeping up with productivity. They were not keeping up with the cost of living increasing. And now I think what you're seeing is like workers being like, wait a minute.
I couldn't agree more. That's a thesis I put out well over a year ago.
Yeah.
That I think what we're seeing is just a natural cycle where the CEOs and executives who got all the cream for 20 or 30 years, it's now the workers, they have all the power. When you have a participation rate that's declining, the employee has the power. Unions are flexing their power. I do think this is a reversion to the mean. I think it's healthy. I think it takes time, quarters and years. I think we have wage inflation for 2 or 3, maybe even 4 years ahead. So yeah,
so
I agree.
If that's the case, then it that's the kind of thing that could be really insensitive to interest rates, right?
Of course.
Unless interest rates really cause a big spike in unemployment, which causes people to, like not be able to find work when they lose their jobs. But we're still, let's think about this kind of rationally.
You add that into a deglobalizing economy. That combination, oh my God, we need more people to do X, Y, and Z than we had planned for before. And it's a recipe for years of wage inflation, in my opinion.
Yeah. And I was going to say I don't know. I lost my train of thought. I'm sorry about that.
That's okay.
Wages will continue to rise, basically, I think. So they're not going to, I know what I was going to say. If you're talking about, and what the Fed has been talking about going, pushing unemployment up to 5%. Well, listen, 5% is still a strong jobs market. It means that people are finding new jobs within, sort of 4 to 6 weeks, right? They're not, or maybe 6
they're not exhausting unemployment.
Exactly. They're not like not finding work. They're able to find new jobs relatively quickly at a 5% rate of unemployment. So I don't know really how much that's going to do to temper wage growth, right? Especially if what we're talking about is it this kind of bouncing back to, more of a historical kind of wage growth, and catching up from all the lost wage growth that we've missed out on for such a long time. And just to bring this back to apartments. So what I want to say is, if this is really happening, right, then we're going to have a very interesting situation for apartment investors, which is the following. There's going to be the fear is going to be imbalance from the reality. The reality is going to be continuing wage growth, which is good for your rents, right? But people being scared of the R word and not renting new apartments is drive rents down, which is going to drive apartment prices down. But eventually what's going to happen is apartment prices will drop to some point where people are going to go, hey, wait a minute, look at all this wage growth we've had. I better start buying apartments. And also the renter is going to be like, well, you know what? I didn't lose my job. And the job market's still strong. And now I've got all this money in the bank that I saved because I've been living with mom and dad for the last 2 years. I'm going to go rent an apartment. So basically you want to get in at that low point where the things where you've got this imbalance where people haven't figured it out yet, where the people haven't figured out like, oh, I have money in my pocket, I can rent an apartment. And apartment investors are not thinking like, oh, look at all these renters on the sidelines who have money in their pocket and they're going to start renting soon. You want to get in at the point of maximum fear, where everybody's
dislocation,
where the renters are fearful and the buyers are fearful and everybody's fearful. That's going to be the best time to buy. So,
and folks, we're going to be talking about this every week with Mr. Jonathan Fomley. Thank you so much.
Absolutely.